This is the best trading strategy for 2026 on this channel. So if you are a person that doesn't have a consistent trading strategy at the moment, then this video is for you. Another thing is that if you are looking for a trading strategy to trade all the markets, including the cryptocurrency market, the indices, the Forex market, even the stock market, then this video, I guarantee that this video is for you, because we are going to include so many things in this video so that at least you can try to have a full trading strategy to trade in 2026. And another thing is that if you're looking for a simple but effective trading strategy for 2026, then also this video is for you if you want to simplify things in your trading. And then lastly, if you want a trading strategy to trade all time frames in the market, then this strategy will be suitable for you. So these are the topics that we are going to cover in this video. We're going to cover the structure and the pattern that you need to trade in the market, how to understand fully the candlesticks, because I see a lot of mistakes people do when they want to understand how a candlesticks behave in the market. A confirmation candlestick here, because we need a confirmation when we enter the market. So this will be useful when we enter the market. And then we will cover different types of entry for sniper and a normal entry. So for those who want to make sniper entries, then you are covered here. And then there is no entry without a stop loss. So we're going to cover stop loss, even take profits. And then we're going to move on to a real chart so that at least we can see practical examples on a real market. And then for bonuses, then we are going to cover candlesticks to understand them like a pro, and then time frames. So I believe it's everything that we are going to cover in this video. So many things that we are going to cover will be covered throughout the video, because this video is not fully scripted. The key here is to understand market structure in depth. So let's start with the bullish structure here. In a bullish structure, we can see that we have a higher high, higher high, higher high, higher high. That means the market is moving to the upside. And in these situations here, where we have this move to the upside, this will be your impulses. These moves will be very strong to the upside. And then this moves to the downside here will be very slow. So that means from here, red is slow. And then this one is fast. But our main focus on the strategy is to focus mostly on this manipulation level from the previous swings. As we can see clearly, this structure here, you will never see it in a real market chart. Maybe 1% of the time. But most of the time, you will see this structure here, where the market is very complicated. You can see that we have some higher highs, and then we have some higher lows here. But look at this correction here in between. This correction, we can clearly see that every time when the market makes a correction, it breaks the previous low before it can continue to the upside once more. But what should we do in this kind of situations? So basically, we have to understand and know how to read the market clearly. This will be helpful once you understand how to read candlesticks. So from here, if we look closely, from this higher high, we went down to the downside to even break this previous low, which was holding price. It just spiked below this low and then moved to the upside. So what most traders will do in this area, most of them will say this is our support level, but the market will just stop them out here and then move to the upside. This is what you are going to understand fully in this video, because I want to make you to understand how to avoid those silly moves in the market, because you just have to follow what the big players are doing in the market so that everything can be very clear. So to be on the safe side of the market, just know that a perfect trade is a trade that trades. Let's say we are in a bullish trend here. You want to trade to the upside. You just wait for a move to break the previous low here and then close inside this range. This will be your perfect trade, because you already took the manipulation. Because if you don't do something like that, this is what could happen to you in the market. Let me draw something here. You will understand very clearly. Let's say right now you move to the upside and then we create this low. We have this low here. Then the market moved to the upside. So once we break this high here, we make a new higher high. And then we have a new higher high here that broke this previous high. Inside this correction, because we're going to have a correction here, inside this correction, the market can be very, very volatile, can make some silly moves. But then, before you can trade to the upside, you have to make sure that on this area here, price has manipulated a previous low before you can enter the market. Don't enter because price is just retracing back to this previous low. Wait for price to at least break this low and then move to the upside. This is where you should be looking to enter the market, not above the previous low. Just go below the low. This will make a lot of sense when we move forward. So here is a clear example here on a bearish structure. We can clearly see that we have a lower high, but inside this lower high, we can see that we have an impulse to the downside, and then we have this huge correction here. But inside this huge correction, we can see that we have some highs here building up. So to trade for a sell, you just have to wait for the market to trade above the previous internal swing highs here, so that you can take the sell to the downside. Other than that, I think it will be best to avoid those kind of trade setups in the market. Like for another demonstration is this one here. We can see that right now, after making this lower high, we break this swing lower low here, and then the market make a correction. But this correction, look how weird it is. It breaks this low to make a lower low, and then it breaks this internal low, internal high, and then it breaks this high here. This is just a correction, expanded flat correction, so you don't have to be scared of it. And then after breaking this high here, price continue to the downside. So basically, you just have to understand the structure and then convert it to this. Just make it difficult, you'll understand it very clearly. Just know that inside a lower low, let's say lower low, lower high, lower low, lower high, the market will move eventually something like this. Let's do something like this. Inside this area, the market can do messy things here, like this. You can see some previous highs being broken, some previous lows being broken, because you are trading in a consolidation market, not in an impulsive market. So to catch the big moves, you just have to trade at the end of each correction. And it's pretty much easy to understand how a correction is and how an impulse is. You just have to look at those strong candlesticks in the market. So from here, before we move on, confirmations will always give us a sign that the market is likely to be traded or not. Without a confirmation, that means we will avoid those kind of markets. And then to take notes, I want you to at least try to backtest. This will help you to inject this trading strategy into your brain, because other than that, there's nothing that you can do. So let's move on. Here we can clearly see that we have covered the bullish structure and the bearish structure. Here we are mainly focusing on liquidity sweep with market structure so that you can understand how the market will be messy. The market is never clean unless if you are using a line chart. But if we are focusing on using candlestick patterns, the market will be messy and you just have to accept it. Unless if you are trading maybe like, what is that pair? Volatility index. But obviously, even that pair right now at this current state is doing some funny moves. So basically, every time when you want to take a buy in the market, let's say you want to take a buy in the market, make sure that there is a low that was taken before you can take a buy. Same applies for a sell. If you want to sell the market to the downside, make sure that there is a high that was manipulated. Like for this example here for the sell, before we can take a sell from these areas here, we have to make sure that there is a high here that price trade above it so that we can't be trapped in the market. Because let's say right now you enter a sell, let's say around this area here, because the market did not trade above this previous high, you are likely to be stopped out. The market can move like this, it can bounce off like this, and then try to move a little bit lower, and then spike to the upside, stop you out, and then continue to your anticipated direction of the market. So that's the only thing that you have to understand. So you just have to trade above the previous high, also returning to the trading range. You don't have to like see those kind of moves that, like for example, another example here is on a bullish trend. When you want to buy in the market, when you want to go long, you have to wait for the market. And this pattern here is everywhere. You'll see it everywhere. You'll see it when we move on to the real market chart. It likes to come down and then trade like this and then spike to the upside very aggressively and then shoot to the downside very aggressively, and then you'll start to see some spikes here. The market will be very, very choppy around this area here, and then start to move to the upside. Most of the people get stopped out by this move. I've seen a lot of traders being stopped out by this move, but I think by the end of this video, you should avoid those kind of things. So here, every time when you see this kind of move here, just wait for this low to be taken out. You will clearly see price action will always tell you a story here. You will have a confirmation candlestick even in the 1 minute time frame, even in the 30-second time frame if you have a trading view pro. But I don't think most of you pay it. Even myself, I don't like to pay it. So from here we can see that we have the market structure. This basically is the same thing as this one here, but right now we can clearly see that it's too much complicated. You can see that we have a high that was broken here before the market can move to the downside, and then you shoot to the upside. But then when you shoot to the downside again, you can see we have a high here and then we have a low. They were all taken out, and then price shoot to the upside. And by the way, these examples here that I'm using for the line chart, I took them from a real market chart. So don't be surprised like you think that I have drawn them by head. But even if I drew them by head, you'll always find a pattern like this. There's no way you can find a pattern like this in the market. Even a pattern like this exists in the market. It exists, this kind of pattern in the market. You'll find them everywhere. But because you understand price action, you'll be able to enter the market around these areas here for the buys and for sells and for longs. So by the end of this video, you'll decide if you want to take only the sniper entries only or not. It's up to you. You will decide. So let's look at this example here. We have this trend here that is moving to the higher high. We have the higher high here, and then we have the higher high. And then price break to the upside, and then return to the range. And then the one sign that you have to notice is because we have this higher low here. The market tried to push to the upside, but it returned. And then it started to break the internal lows here. You just know that that is a sign of a reversal. And once price breaks this major low here, and it has manipulated the previous high, that means we are likely to shoot to the downside once more. And someone will say that, okay, the market sometimes, I'll draw the same structure like this. It does something like this, and then we have this high, low, high, and low. And then price eventually do something like this, and then drops without breaking this high here. You are not wrong. This same structure here is the same as this one because this high here was broken here. It all depends on which one you are going to take in the market, but that one is a story for another day. But I think maybe during some examples, I'll try to show you those kind of moves in the market. They happen a lot. You just have to be able to read that kind of price action. So moving on, I think from the market structure, I think we both agree that we need to trade after a liquidity has been swept. Other than that, we just avoid those kind of moves in the market. So here is a liquidity sweep examples. We can clearly see that by reading this chart here, we can see that we have this high and then we have this high. Before the market can shoot to the downside, we can see that price traded above this high here. That is why you see this move to the downside. And every time before we move to the upside, we can clearly see that price also manipulated this low here. And then price shoot to the upside. And then it manipulates this high and then shoot to the downside. That's how at least you can try to understand it. It's not even that difficult to understand, but I guess everything will be clear after watching this video. You just have to take it slow because this video I'm making sure that I'm trying to explain everything very, very slow so that at least you can try to understand what I am trying to teach you in this video. So from here, we can see that we have this high, have this low. We can even draw the market structure. I will even erase after. This is the pattern that I was talking about. Look closely. We have this high, we have this high, we have this low, I mean to say low, this is the high, and then we have this high, we have this low. Let's focus mainly on this price action here. You'll understand clearly. Before price can break this, we can clearly see that we have a lot of bearish engulfing candlesticks here. But if we look at the candlesticks from this area, there is no sign of a reversal to the downside. Even this bearish engulfing candlestick is not in our books. You will understand why after watching this video, why this candlestick will make you to fail during this setup. So this candlestick is not a sign for a sell. This one, this one, this one. Only this one is a sign for a sell, but this one is a bullish candlestick. But you'll understand why I am saying this. Because right now we want to sell from here. But we can clearly see that the market shoot to the upside, makes a high, breaking this a high here. And look at the candlesticks that breaks the previous high. They are very strong. And then we start to see price action confirmations here. And then if you want to sell, that means we have this low here. We have this low, but look closely. We tried to push to the upside once more here, but we failed. After failing to break to the upside from here, we shoot to the downside. But how are we going to sell from here? It's because we have an internal low that was broken, and then we have this low here. And look at the price action. It's very strong to the downside right now. So that means we are likely to reverse. But if you want to confirm, we have to wait for this low to be taken out. And look at the price action that breaks this low. They are very strong like this one. And comparing this price action from the previous ones when we were moving to the upside, they were very, very strong. So this is a sign that we are doing the same thing but the opposite way. So once we break this low here and this low here, we can see that clearly the market structure has changed. We are not breaking new highs. We are making lower highs. So this will be some signs to enter the market. And the market did not disappoint. It dropped to the downside. That's how at least you can try to understand market structure. And another thing that I want to point out, let me draw the market structure from this candlestick by candlestick. You'll understand it very clearly. We start from here. We move to the upside. This candlestick, the red one, push the market to the downside. We move to the upside. We move like this. And then we shoot to the downside very aggressively. We move to the upside. And then we move to the downside. Are we making a new lower low? No. The market makes a new high, drops lower, makes a new high, drops lower, makes a new high, drops lower. Are we making a new higher high? Not yet. Not yet. Again. So this is where you'll take your decisions that the market is likely to push to the downside, or it broke this low here to push to the upside. So we are in the middle of a trend. But as always, price action will always tell you the same thing over and over again. Let's continue with this one here. You'll see the market structure very clearly. You can clearly see this is the market structure. Using candlesticks, you can draw market structure very, very clearly. In this way, if you understand how to do this, you'll understand how the market behaves all the time. Because the market doesn't move as clean as how people say, like this, and then it breaks structure like this. No, it doesn't move like that. You can clearly see that during this area here, when the market was trying to push to the downside, it broke this high, but then it made a new low again, and then pushed to the upside to break this high and then drop lower. That's how at least you can try to understand it. And then if you try to draw this kind of candlesticks in the market, like you just take a lot of screenshot and then put them in somewhere like a whiteboard, something on there's a lot of apps that are using whiteboards nowadays, and then try to draw them a lot. You will understand this market structure perfectly. So I guarantee you that that will be the best investment of your life, to understand market structure. This one here, the basic market structure, the change of character or something like this. This one, for me, in my books, it's still the basics. It's like saying higher highs and higher lows. But once you get too deep into this thing here, you will understand market structure very perfectly, and you'll be able to forecast the market very easily. So let's move on to understand how candlesticks will behave. And by the end of this video, you will understand how the market behaves on every candlestick from starting here, ending here. You'll understand how a candlestick will behave. So let's move on. You'll see. This is the basic candlestick pattern here. We have the bullish candlestick, and then we have the bearish candlestick. From the bullish candlestick to the bearish candlestick, we will explain everything so that we can understand how a candlestick behave. The first thing that you need to understand is that in the market we have a bullish and a bearish candlestick. In a bullish market, a bullish candlestick will open at the bottom here. It will move to the upside to make this high, and then it will drop and then close around this area. And obviously, once it opens, to have this lower wick, price should also move to the downside. That is why we have something like this. So for now, let's say we have a clear demonstration. This is the open. We move to the downside to make a low, and then we move to the upside to make a high, and then we come and close. And then in between the close and the open, this is where we have the body. This is the body here. And then from the opening and the closing, from the closing and the opening to the low and then to the high, this is where we have the wicks. That is why we have the upper wick and the lower wick. But if we look closely here, let's look at the bearish candlestick. The bearish candlestick opens at the top, vice versa to the opening of the bullish candlestick. But it doesn't mean a bullish candlestick can't open here. It can still open here. It all depends where price is at the moment. So every candlestick can develop at any price point in the market. So let's say for now we have let's say maybe the monthly time frame. Let's say price is at, for let's say maybe this is the Bitcoin. We have price maybe let's say at 65k. We open on the other month. We can open here, move to the upside, shoot to the downside, make a low, and then close. This will create a bearish candlestick because we opened at the top. The same thing applies. We can still have another bullish candlestick here. Can have another bullish candlestick here, and then it closes around here. And then we can still have another bullish candlestick to have the same low as the bearish candlestick right there. That's how at least you can try to understand it. But the market doesn't move like that. If the market was moving that easily, like we open and then we move to the downside to make a low, and then we move to the upside to make a high, and then we come and close to create a body here. This will be our bullish candlestick. That's how at least you can try to understand it. But in reality, the market, it doesn't move like this. No. It doesn't move like that. Let me give you a real clear view of how the market behaves in a real market chart, not in a textbook examples. We open here, okay? Price can start to move to the upside, shoot to the downside, do something like this, and then close. So basically here, this is where the market becomes very tricky. We opened here, we closed here. This will be our body, and then we have this high, and then we have this low. But look at how the market behaved throughout. It was a little bit choppy. It went through everywhere. Went up and then went down, went up, went down. That's not, this is how the market really move. This is the reality of the market movement. Because we have a bearish candlestick here, it doesn't mean the market opened, moved to the upside, shoot to the downside, and then come and close. Close, this is the open. This is just an example. This is the reality. You have to understand that in perspective. So, I think we covered the difficult part here. So, let's move on to these candlesticks here. You see these candlesticks here. These two here, you don't even know if whether this is a bearish or this is a bullish candlestick. You don't even know. So, let's say right now, look at this candlestick. Who is in control of the market here? No one. Because even if we open here and close here, this will be a bullish candlestick. But then, look at the price action. It pushed to the upside, pushed to the downside. Here, it pushed to the downside, pushed to the upside. So that means this one is an indecision candlestick. Even if we put those theories vice versa, like we open here and then we close here, this will be a bearish candlestick. But the problem here is that we push the upside, we push the downside. Here, the same thing. So there is no power here and even here. There is money involved in the market, but you can clearly see that everyone is fighting for that price level until someone wins. Obviously, the big banks will win. So, if you can understand a plain example like this one will be very easy to understand. So, let's say right now, from this one here, I want to make it a little bit difficult. We open and then we close here. This will be your bullish candlestick. Even if this is a bullish candlestick, but look at the wicks. Look at the wicks. We opened here. Price tried to push lower. It failed. And then it shoot to the upside. And then it shoot aggressively to the upside. But then it failed. And then the market came in close. When price closes, most of the time you'll see that it closed while the market was moving to the downside. This goes to show that price is rejecting this move to the upside. So that means price is likely to move to the downside. The same applies on this one here. Even if we have this one, if was like bullish, this one here, obviously this one is bearish. We can clearly see that we have the same candlestick, but they are all rejecting a price to the downside. They want to push price to the downside because we have a longer wick on the top. Even if this here was a bullish candlestick, the same theory still applies. So let me show you an example of Bitcoin here. You'll clearly understand it. Here, I believe this was Bitcoin. If I'm not mistaken, oh, it's gold. This is gold here. This is gold. If you look closely here on this two candlestick, most people can still buy, or I mean, they can still sell, looking at the market like every bearish candlestick is a sell. I know there are still those kind of people in the market. If you look closely at this candlestick and even this one here, the pattern applies. We have 3 in here and then we have 2 here. And we can clearly see that the market pushed to the upside. Okay? I hope you understand what I mean. The longer the wick, the more the market will respect that price to continue to the same direction the market was rejecting. Even on this area, we can see that we rejected and closed bullish, but the price did not fall to the downside. It did not break here. This is an inside bar. And then the next candlestick reject and then close bearish. It's confusing, right? But remember here. And then we have another one here. It's rejecting to the upside. Then this is not a clear confirmation because here we have a rejection that price is likely to push to the downside. But we didn't break a lot of highs here. Only one, this one. And the one that we are breaking is the one that rejected the move to the downside. I hope you understand what I mean. This candlestick here is rejecting the move to the downside. That is why we have a longer wick here. But this price section here did not even try to break here. Maybe if we have something like this, that will be at least valid in my books. Because we don't have that candlestick here, that means this move here is not supporting a bearish trend. This will be very useful when we move forward. Look closely at this bigger one here. We can clearly see that price shoot to the downside but still closed here. That is why you see a move to the upside slightly. And we still have this one here and even this one. That is why you still see a move to the upside currently. But you will just see this video, I don't know when, but I think I'll upload it very early. So let's move on to another example. Here we can see that we have rejection candlesticks. Let's talk about them so that at least you can try to understand them very clearly because they are very useful for entries. After every low that you see that is being broken, you have to check if there is a rejection or not. And if you have a rejection like this, you can still trade to the upside because obviously price broke this low very aggressively. Look at this candlesticks. It goes to show that the market was shooting to the downside, and then before it can move higher, it gave you a sign that I'm rejecting this level here. I need to push to the upside. That's how at least you can try to understand it. But obviously, you don't just have to choose any point here. You can clearly see that we have this low. There might be a FVG on this other side, and then price entering maybe your level here. That's how at least you can try to at least improve your analysis. But sometimes it doesn't even work like that. Let's look at this area here. We're pushing to the downside very aggressively, breaking this low. Then we have a rejection. Price failed. And then we have this candlestick here. Look at this one, this two here. This is a sign that price is likely to push to the downside. So obviously that is why you see this low is being broken. It got broken and then it got rejected. But we still have two candlesticks here that are still supporting the downtrend. And we can clearly see that we have a bearish engulfing candlestick plus two rejections. This one alone won't fight this. It won't even fight it at all. Unlike this one here, where we closed here and then aggressively shoot to the downside and then move to the upside very aggressively. And you will start to see those kind of patterns when you practice a lot. Even here, we break this low very aggressively. But right now, there is no supporting wicks from the previous candlesticks. These ones are over because they already tapped this low here. I hope you understand what I mean. That is why you see price after breaking this low here, price rejected, but this is a bearish candlestick. But then price moved to the upside. That's how at least you can try to understand it. And another one here that I want to talk about is this area here. We have a bearish engulfing candlestick. Look at this candlestick. It's rejecting the move to the upside because we have a longer wick from the upside. And then we have a supporting candlestick. Most of the people will be buying here because they see a bullish candlestick, but this is a minor correction in the lower time frames. Because right now you understand how price action behaves, you'll understand this very, very clearly. You have to have some supporting candlesticks to validate your trading setup. In that way, it will make things very, very easy. The same thing here. Let me show you something. We have one here. Let me just write it down. You'll see it very clearly. We have a bearish engulfing candlestick here. And then number 2, we have a supporting rejection candlestick, which is this one. That is why you see a move to the downside very, very aggressively. So if we move forward around this area, I just noticed this right now. We have this one, a bullish engulfing candlestick here. Number 2, we have a supporting rejection candlestick. This one here. And then silently we have this move here. You can take this candlestick alone as your confirmation. Even this one here, it can be your confirmation candlestick. Because, and another thing that I want to point out is that a lot of people will make mistakes. Let me highlight this area here. Before we can validate that these two entry, these confirmations here, we have to have, let's say maybe we're taking a sell. On a sell, we have to have a bearish engulfing and then a supporting rejection, rejecting the upside. So that means the candlestick must have an upper wick. The wick here has to be long. And then for a buy, you have to have a bullish engulfing. And then also followed by a rejection that shows a rejection from the bearish side. If we have something that is not matching, that means our analysis will be wrong. I hope you understand what I mean. Here we can clearly see that. Let's draw the market structure. Here we have this move. Someone maybe will be looking for a sell here, but there's a lot that is going on here. We recently broke this low and then we broke this high. Just look at price action. Look at this area compared to this one. This one is very slow. This one is very fast. So that means this one is a correction for the market to push to the upside. So that means every entry that you are looking for is a bullish entry. So we have a rejection, the first one, followed by a bullish engulfing candlestick, a bullish engulfing, and then we have another candlestick here. This looks like a bearish engulfing candlestick, but we'll write it from the side. We have a bearish engulfing candlestick, and also it's rejecting. So that means this sell and a buy are doing at the same time, but there was no confirmation for a bullish trade. But there is. If you understand this one, the supporting one, the other one that follows is that we have to have a rejection followed by an engulfing candlestick. Sorry, this will be a bullish candle. That is why we have this rejection, bullish candlestick, move to the upside. Let's try to look for some examples. We have more rejections here. this will be very clear to explain, because this will be a lot of information that we need to digest here. This one won't be valid because we have a rejection that is rejecting from the upside. And as I said before, if you draw your market structure like this, you'll understand very clearly. You can clearly see that right now we broke this low and then made a rejection. That's why you see price moving to the upside. Even here, broke the low, bullish engulfing candlestick, but there is no supporting candlesticks at the moment. We have a high, price breaks, but then this is just a mess. And then suddenly we have this huge rejection. This huge rejection, most of the time, reverse the market. If you don't trust this one, then that means you can wait for this one here. We have a rejection and then followed by a engulfing candlestick. That's how at least you can try to understand it. Rejection plus a bearish candlestick. Okay? So, I guess this is everything that you need for confirmations. And if you have reached this part of the video right now, please consider subscribing to the channel. And also you will find this PDF for free in the Telegram. The link will be in the description below. Go and check it out, because I knew some of you won't even reach this part of the video. If you have reached this part of the video right here, please leave a like below and tell me on which country you are watching from. So let's move on. This one is not even that difficult to understand. You can clearly see it. We break the high, followed by a rejection, followed by a bearish engulfing candlestick. You sell to the downside. That's everything that you need to understand. This is your confirmation, a clear confirmation. You can use this in your 1 minute time frame, even 2 minutes time frame. Every time when you see this kind of thing, the market is likely to reverse. I've done it a lot of times. I've backtested this more than, I don't even want to know, maybe a million times. This one, you're not going to stick for long. You're just going to move on. This is where you'll be able to make your sniper entries. This is a normal entry. Let's say price broke this low here, and then you want to enter the market, and then you see a rejection here. You can still enter the market at the close of this candlestick and then put your stop loss below. And then your target will be around this highs here, or even the fair value gaps that you can still spot. But here clearly we can see that there is no fair value gap around this area. That means you can target this highs here, because the market will eventually move to the upside very aggressively. This is your normal entry on the close. So let's move on to the sniper entry and the retracement entry. Here we can clearly see that we have this move, this bearish candlestick here, and then followed by a rejection candlestick. You can still enter the close, but it will be the same as this one. What if we don't want to risk too much on the trade? We can put a buy limit order on the previous candlestick's low here, and hope for the market to trigger it, for the market to move to the upside. But if you don't want to miss it, you can put a buy limit order on the open of this bullish candlestick. Yes, sometimes this candlestick can be a bearish candlestick. You just do the same. The same thing applies every time. It's just that I don't see any examples that I can demonstrate right now. Okay. And yes, guys, don't forget that if you don't use proper risk management, you will be stopped out. Let me show you an example of a loss here. You have a bearish engulfing. Maybe let's say Price broke this low, made a rejection. If your stop loss is here and then you took a long, you'll be stopped out by this candlestick. But obviously, if you don't have a stop loss, the market will move to the upside with your buy, then put you in the negative. You'll be holding until the market takes your account and give it to the other person who is watching this video. So I guess that this is the end of part 1 of this video. I hope this information was very valuable to you guys, but we will see what we can do. We have this candlestick here, which is also a rejection here. This is gold on the 3 minutes time frame. Obviously, I was going to rewind so that we can at least learn from it. So we can clearly see that we have a rejection here, but if we are not confident enough, we can wait for a candlestick here. We have a rejection right now, so that means the only thing that we can wait for here, we can wait for a bullish engulfing candlestick. This is the only thing that we can wait for on this area here. So if that bullish engulfing candlestick doesn't appear, that means forget about that trade, bruh, and move on with life. There's a lot of pairs that you can trade. So here we can clearly see that we have a bullish engulfing candlestick. But if you want to trade this efficiently, you can put a buy limit order from here. Bullish engulfing candlestick like to retrace a lot of times. Like it likes to retrace back to this area and then to the upside. Or even you can put a buy limit order here because we have a V shape here. You can clearly see that we have a V shape. Obviously, some lows might be manipulated before we can see price move into the upside once more. So from here, if you want to trade, you put a long position, maybe on the close, stop loss below, with a little bit of added spread size, and then you can target the first high here, and then you can target even the fair value gap around this area. Here we have a fair value gap. This is where the market rejected. Have a fair value gap around that area. So right now, the only thing that we need to do is wait for the market to react. So obviously, once we enter the trade, we can clearly see the thing that I was talking about, that the market is likely to trade below the V formation here. We have the V formation like this, something like a head and shoulder. You can call it that, doesn't matter. The pattern is just a pattern, guys. So obviously, this lows here are still a target before the market can move to the upside. Just have to know that every time when you see this kind of pattern forming, just know that the market is likely to do some silly stuff before it can move to another direction of the market. And you can clearly see that price targeted. Okay, wait. Price also targeted this low here, the previous low. So that means you don't have a sniper entry in this section here, but you can still try to enter the market right there when price tried to retrace, but you didn't hear that from me. So basically, you just wait for the market to do whatever it wants to do. Increase this one here. Yeah, but it's already moving. So that's how at least you can try to understand how the market behaves. So even during an up move, you can still enter more trades if you like, but I don't really like to do that a lot because the market is just the market, you know. And once price hit the first TP here, the first take profit, which is here at this area, that means right now we can take this trade here and then close it, put this one above our entry, maybe somewhere in between this lows here, just to protect more profit, and then just hedge it to the upside until until you feel comfortable to close it, because already you are in profit on this one. That's how at least you can maximize. And I still tell a lot of people that a trading strategy can be very good, but once you have a worst risk management strategy, you'll always blow your accounts no matter what. So let's look at another example. This is gold on the 1 minute time frame. I want to look at how many trades we can get. This is the current price section. You can see there's no run button here. Let me see how many trades we can get from today. This is the 1 minute time frame. Price was very, very fast. Let's see, based on the information that you have learned so far from this video. We have the low that is broken here. Change this color to black. I like black. We have a rejection here. Even if we compare this area and this one here, we can see that we are rejecting mostly to the downside, and then followed by a engulfing candlestick to the upside. That is why you see price moving to the upside. Rejection plus a bullish engulfing candlestick. Let's remove this one, and here you can clearly see another one. We break to the upside, reject here, and then there's no bearish engulfing until this candlestick. But obviously this trade will be risky to trade because we are already at the nearest low. That means the only profit that you're going to get is this one here, which is very small, like just one candlestick. Where's your spread size? Okay, so I guess this one you're just going to avoid. So let's look. There are a lot of examples that we can find everywhere in this. Gold just produce a lot of candlesticks here. Let's look at this one. This one is just so simple. We break the high. We break the high. We have the first rejection here. We have the first rejection. Then followed by a second rejection, because we want to confirm the entry here. And also we can clearly see that price broke above this previous high here. And obviously price broke this previous high aggressively without even making even a single bearish candlestick. And then we have the second rejection, and price is still closing inside this range here. So the only thing that you can do right now is just to wait for a bearish engulfing candlestick. So your entry will be a little bit late here. I know a lot of you missed this trade because this video was uploaded now, and then you get this whole move here, and then you target this low as your take profit first. But because this is the 1 minute time frame, once you enter the market, obviously price will just shoot down, unless if your broker did you dirty by opening the spread sizes, because I know some brokers like to do some dirty stuffs. Let's look at a normal market condition where you have something like this. This is a clear continuation. But if we read closely from the same price point here, is the same thing as around this area. Look, we break above this high, we broke above this high. Okay. We have a lot of rejections. Let's look closely and read the rejections here. We broke above this high very aggressively. You know, this candlestick here, it means a lot, because after this candlestick, we have to see a lot of reaction in the market. And we can clearly see that this one is a indecision candlestick, followed by a rejection candlestick, which is also a bullish candlestick. Most people will start to buy on this candlestick here. But because right now you understand that the power is inside the wick, and you can clearly see that we have a lot of space here. We have a lot of space that is left. That means the market is rejecting to the downside, followed by a bearish engulfing candlestick here. And then the market just shoot to the downside. So you can clearly see that this is pretty much easy. Oh, okay. And then we have another one here. This is just a continuation to the upside. if you use trend lines, you can do maybe something like this, but I don't draw my trend lines like this. Let's say this is a breakout, and then we are going to do the same thing again. Price breaks this low, and then we have a lot of rejections in the market here. You can clearly see that this rejections, followed by a bullish engulfing candlestick, and it even retraced. So that means you can enter the trade right there, target this high, or maybe this high first here, and even the fair value gap here, this fair value gap, it even touched that fair value gap. So I guess if you want more information about this trading strategy and how to tackle some different environments in the market, please feel free to contact me on Telegram if you have reached this end of the video. I really appreciate you for watching the video. Please give this video a like so that you can reach maybe at least 100 people. So I guess I'll see you on the next one.